Welcome to Luck Scout Economic News and Strategies. Jerome Powell, the head honcho of the Federal Reserve, gave a big speech today on July 2, 2024. This wasn't just any speech, it was one of those moments that everyone in the financial world marks on their calendar. Powell's words have the power to influence markets, shape economic policies, and even affect the global economy. Everyone on Wall Street was glued to their screens. Traders, analysts, and investors were all eagerly waiting to dissect every word, every pause, and every nuance of Powell's address. Why? Because when Powell speaks, the market listens. His speeches are like a barometer for the financial climate, providing insights and hints about the future direction of monetary policy. His words can move mountains of money. A single sentence from Powell can send stocks soaring or plummeting, influence interest rates, and even impact the value of the dollar. This speech was no different. The market was on edge, reacting to every detail. It was a report card on the economy and a sneak peek into the Fed's next move. Powell didn't sugarcoat things. He laid out the challenges and the progress made so far. Inflation is still public enemy number one. Despite efforts to control it, inflation remains a significant concern. It's down from its peak, but not out for the count. The battle against inflation is ongoing, and the Fed is committed to winning it. The Fed wants it at 2%, a goal that seems far off right now. Achieving this target is crucial for economic stability. Powell made it clear, the Fed won't rest until inflation is crushed. They are prepared to take whatever measures are necessary. This speech wasn't all doom and gloom. Powell also highlighted the positive aspects of the economy. Powell acknowledged the economy's resilience. We've had decent growth. Jobs are being created. The labor market remains strong, and consumer spending is holding up. But he also hinted at potential speed bumps ahead. The path to economic recovery is not without its challenges. Higher interest rates are putting the brakes on borrowing and spending. This is a necessary measure to control inflation, but comes with its own set of risks. The big takeaway? The Fed is walking a tightrope. They need to balance controlling inflation with supporting economic growth. They need to tame inflation without crashing the economy. It's a complex and delicate task that requires careful navigation. It's a delicate balancing act, and Powell is the ringmaster. He must juggle various economic elements to maintain stability and foster growth. The world watches closely, knowing that his decisions will shape the future of the economy. After the inflation update, Powell turned his attention to the overall health of the economy. It's a bit of a mixed bag. There are bright spots, but also areas of concern. On the positive side, the economy is still growing. It's not gangbusters growth, but it's growth nonetheless. Powell cited the strong labor market as a major plus. Unemployment is low and businesses are hiring. However, Powell also acknowledged the headwinds facing the economy. Higher interest rates are starting to bite. Consumers are feeling the pinch, and businesses are pulling back on investment. The Fed is aware that its actions have consequences. They know that raising interest rates too aggressively could tip the economy into recession. That's why they're proceeding with caution. But they're also not afraid to do what needs to be done to get inflation under control.
Interest rate hike, is it a looming threat? The million-dollar question on everyone's mind was, will the Fed raise interest rates again? Powell played his cards close to his chest. He didn't give a definitive answer, but he did drop some heavy hints. Powell emphasized that the Fed's decisions will be data-dependent. They'll be watching the economic tea leaves closely. If inflation doesn't cool down, further rate hikes are on the table. This sent a shiver down the spines of investors. He reminded everyone that the Fed's job is to maintain price stability. That means keeping inflation in check. And if that means raising rates, so be it. Powell's message was clear. Don't expect the Fed to pivot anytime soon. The Fed's next meeting is in a few weeks. All eyes will be on Powell and his colleagues. Will they hike rates, or will they hit the pause button? The answer, as always, will depend on the data.
Higher rates are a pain for borrowers, a boon for savers. Powell's hawkish tone on interest rates sent ripples through the economy, affecting various sectors in different ways. Higher rates are a double-edged sword, bringing both opportunities and challenges. They're great for savers who can finally see their money grow, but they're a pain for borrowers who face higher costs. Let's start with the good news for savers. If you've got cash in the bank, you're finally starting to earn some decent interest, which has been long overdue. Savings accounts and CDs are offering higher yields than they have in years, providing a much-needed boost. That's good news for retirees and anyone else who relies on interest income, giving them more financial security. It also helps those planning for future expenses like college tuition or a new home.
On the flip side, higher rates make it more expensive to borrow money. Mortgage rates have skyrocketed, making home ownership more costly. Credit card interest rates are through the roof, adding to the financial burden of everyday expenses. This is putting a squeeze on consumers and businesses alike, making it harder to manage cash flow and investments. Powell acknowledged that higher rates are having an impact, but he emphasized the necessity of these measures. He said the Fed is monitoring the situation closely, ready to adjust policies if needed, but he also made it clear that the Fed's priority is to fight inflation, aiming for long-term economic stability. Even if it means some short-term pain for borrowers, the goal is to create a healthier economy in the long run. It's a delicate balancing act, trying to manage inflation while supporting growth, and the effects are felt by everyone. As we look ahead, the hope is that these measures will lead to a more stable and prosperous future for all.
Short-term bonds take center stage. Powell's speech sent shockwaves through the stock and bond markets. Investors were left scrambling to reposition their portfolios for a world of higher interest rates. One asset class that's been benefiting from the Fed's rate hikes is short-term bonds. These bonds offer higher yields than they did just a few months ago, and because they have shorter maturities, they're less sensitive to interest rate risk. Powell's hawkish tone on inflation suggests that short-term bonds could continue to outperform in the coming months. Investors are looking for a safe haven for their cash, and right now, short-term bonds fit the bill. Of course, there's no such thing as a risk-free investment, but in these uncertain times, short-term bonds offer a relatively attractive combination of yield and safety.
While Powell's speech sent shivers down the spines of some investors, others saw opportunity knocking. The market's reaction was mixed, with some fearing the worst, while others saw a chance to pivot their strategies. Specifically, in the realm of high-dividend stocks, which have become increasingly appealing in the wake of Powell's remarks. These are companies that pay out a portion of their profits to shareholders, providing a steady stream of income. This income can be particularly valuable during times of market volatility, offering a cushion against the ups and downs. Powell's emphasis on combating inflation has put a premium on stability. His focus on maintaining economic balance has led investors to prioritize sectors that can weather the storm. Investors are seeking refuge from the storm in sectors known for their resilience and consistent payouts. These sectors are seen as safe harbors in turbulent times. This has put a spotlight on utilities, healthcare, and consumer staples. These sectors are traditionally known for their stability and reliability. Utilities, with their regulated businesses and essential services, offer a bond-like consistency. They provide essential services that people rely on, making them a stable investment choice. Healthcare, driven by demographic trends and the need for medical care, provides a degree of insulation from economic downturns. The demand for healthcare services remains steady, regardless of economic conditions, and consumer staples, encompassing everyday necessities, benefit from consistent demand regardless of the economic climate. Products like food, beverages, and household items are always in demand. These sectors, with their attractive dividend yields, have become safe havens in the current market environment. Investors are drawn to the reliable income these stocks can provide. As Powell steers the ship through choppy waters, his guidance has become a beacon for investors looking for stability. Investors are battening down the hatches and seeking shelter in the stability of high dividend stocks. These stocks offer a sense of security and predictability in an otherwise uncertain market. By analyzing market trends and adjusting their portfolios accordingly, investors are positioning themselves to weather the economic storm. The focus is on long-term stability and income generation. Financial advisors are also playing a crucial role, discussing strategies with their clients to ensure their investments are aligned with their risk tolerance and financial goals. With a diversified portfolio that includes high dividend stocks, investors are feeling more confident about their financial future. The key is to stay informed and make strategic decisions based on reliable information. Please like the video and share it with others. Thank you for watching.